Hello everyone. In this video I'm going to walk you through the notes for distributions to shareholders. So to start, to give you a little background on my relationship with this topic, I published 2 papers in the last year on the topic of repurchases, stock repurchases, something you might hear about in the news a lot lately, especially with providing interest-free loans to large corporations. One of the restrictions is that they're not allowed to repurchase their stock for some period of time. I've heard 1 year. I've heard until the loan's paid off. But there's going to be a restriction on that. Some businesses have faced a lot of criticism for using all their cash up to repurchase shares of stock, their own shares of stock, and then not having anything available for a rainy day, for having a bad month or a bad few months. And so we're going to talk a little bit about that as we go through this topic. But first we're going to start off with talking about the relationship between distributions and firm value. And notice the name of this topic isn't cash distributions, although that's primarily what we're going to talk about. There are other types of distributions, specifically stock distributions, that a company can give out to its shareholders. Primarily, we're going to talk about cash distributions, though. So what's the relationship between distributions and firm value? So for a firm, or really any investment, to have value for an investor, it has to provide something of value to that investor. Primarily, this is money. The idea is that if I buy a share of stock on a company, at some point, that company is going to pay me a dividend, or at some point, that company is going to repurchase my stock back from me at a higher price than what I paid for it. And I have to have that expectation, even though that may not come to fruition. I need to have that expectation in order to induce me to purchase the stock or purchase the bond or purchase whatever the investment is. It doesn't have to be cash. You can, invest in, and one time I invested in air quotes, I can't do air quotes over a microphone, but invested in a grocery co-op. And so my wife and I bought a membership. It was considered by the co-op to be an investment. And then in exchange for that investment, we received lower prices on food. So essentially we got cheaper food, more food than we would have gotten without that investment. And so sometimes what you receive in value can be different than cash, but when we talk about the stock market, it's cash. Okay? What we get in exchange for buying shares of stock, or really buying bonds, is the expectation of more cash in the future. So for any investment to have value to an investor, the investment must be expected to provide something of value to the investor in the future. The something of value is generally cash. For stocks, this means that the issuing firm must be expected to pay dividends or repurchase stock in the future. So just keep that in mind. For any firm, for any investment to have value, to induce people to purchase that investment, there must be an expectation that that investment is going to generate cash for the investor in the future. So the way that a firm distributes cash is known as its distribution policy. So can a company increase its value through its choice of distribution policy? And the answer is yes. We know that the choice of distribution type, and the amount of distributions affect the value of the firm. And we'll talk about this more later, but whenever a firm announces an unexpected change in their distribution policy, then this has an effect on the stock price of the firm. So distribution policy consists of the type of distribution. Generally, this is going to be dividends or stock repurchases. And you'll also see this as buybacks. You might hear stock buybacks. It's the same thing as a stock repurchase. The amount of the distribution and the frequency of the distribution. Blank is the percentage of net income distributed to shareholders through cash dividends or stock repurchases, and that blank is the distribution ratio. Blank is the percentage of net income paid as cash dividends, and if you've heard of any of these terms, this is the one you probably heard of. This is the payout ratio. And the blank must strike a balance between cash payments and capital gains to maximize the stock price. So the optimal distribution policy. So how do we maximize the value of the firm? We have to choose a good balance between paying out cash today for the firm, if they can, and if that's desirable, and investing money back into the firm, investing the cash the firm generates back into the firm in order to grow the value of the firm's stock price. So the next item I have on here is a recent history of cash distributions. I've included a file out on D12 for you to look at here. This is a briefing by Yardeni Research. Dr. Yardeni actually came to Washburn about 2 years ago and talked about his company and what they did and how they did research, and actually gave some insight to some of our economics and finance classes on what was going on in the market at that time. So this is out on D12 for you. I'm going to scroll down here. It's got a lot of different graphs, and there's one I want to show you in particular. It's this figure number 5. So it's got here the value of the S&P 500 index, and this is on the left hand, the amount of buybacks and dividends in trillions of dollars over on the right hand axis. And you can see here, this goes back to 1999. The green are the dividends. I'm going to say that's purple, but whatever works for you. Is the other is the buybacks. You can see here that dividends tend to be very stable. They don't move a lot over time. We saw a dip here in 2008 and 2009. That was because of the Great Recession, the panic in the financial markets. A lot of firms didn't have liquidity to pay out dividends at this time, and so we saw dividends decrease, and they've slowly been going up over time. In fact, now dividends are much higher in terms of dollar amounts than they were 20 years ago. So buybacks are a different story, and you can see here the dollar amount of buybacks is much more volatile than it is for dividends. And this is really the idea of, and we'll talk more about this later, but the idea that the dividends for a firm should be stable, that the people that invest in dividend paying stocks want a stable source of income being generated from those stocks. So a lot of people that are retired, a lot of institutions that require fairly stable and predictable payments, cash payments, things like life insurance companies, pension funds. Those are going to be the kinds of investors that dividend-paying firms really attract. And so they want very stable cash flows. Then over here we see the stock buybacks, very volatile. In good years, when the economy is doing well, the stock buybacks are high. And when the market's doing well, you can see that the index value really tracks with the dollar amount of buybacks. One thing about stock buybacks that's different than dividends, and we'll talk more about this later as well, is that they're very flexible. So whenever a company drops their dividend payment, that company's stock price is going to get hurt because investors don't like that. Stock buybacks, though, that's not the case for. There's no expectation once a firm buys back stock that they'll continue to do that in the future. And so they don't really get hurt whenever they stop their buybacks. So let's go back, and I encourage you to look through this report. It's a lot of graphs, but at least to me, I find it very interesting, kind of how buybacks and dividends have been paid out over the last 2 decades. All right. So a recent history of cash distributions. So prior to around 1998, the dollar amount of dividends paid, and this is for U.S. firms, was more than the dollar amount of cash repurchases. Stock repurchases. After around 1999, we saw, and I'm just going to pull that back up here again, we saw the amount of stock repurchases begin to outpace. So you can see here where around 2000, the amount of stock buybacks or stock repurchases went up compared to the amount of dividends paid. And then really after 2003, 2004, buybacks for the S&P 500 really took off then. And so stock repurchases increased dramatically relative to dividends after 2003 and then fell again going into the 2008-2009 financial crisis. And then after that crisis, stock repurchases started gaining more traction. Increase in amount. So again, stock repurchases are very flexible, and we're going to talk about one strategy later on where companies use stock repurchases to get rid of excess cash that they might not believe they'll be able to generate in the future. So let's get in. We're going to start with dividends. We're going to talk about dividend theories first. So there's two gentlemen, Miller and Modigliani, commonly referred to as M&M. They did not start a candy company. That's actually Mars that makes M&Ms, but it's easier to say than Miller and Modigliani. They came up with a number of theories. Remember, these are just theories. They started with a lot of different assumptions that aren't realistic. And then as they started getting rid of those assumptions, they got closer and closer to a workable theory. And then we're going to talk about their theories and some other folks who had some theories about cash distributions, and specifically about dividend distributions, and how that's worked kind of to a model today where we have a good idea of how companies generally decide to pay dividends. So the first idea that Miller and Modigliani had was that the firm's value is determined by its basic earning power and business risk, that nothing else mattered. We're going to come back to capital structure. We're going to see these two folks again. They had the same idea with capital structure. Capital structure doesn't matter. So they said investors can create synthetic dividends, so dividend policy is irrelevant. In other words, if the firm pays no dividends, the firm can reinvest its cash into increasing the basic earning power of the business and increase the value of its stock by doing that, by increasing the basic earning power of the business. As the stock value increases, investors can sell off portions of their ownership without decreasing the value of their investment below the original value. So for example, let's say I purchased stock A at the beginning of this year. For $100. During the year, stock A's issuing firm invest in and increases its basic earning power and the value of the stock increases to $105 per share. Okay, so we went from $100 per share, and I should have that up on there, but it's $100 per share, and it increases to $5 a share. I can sell off $5 of my ownership. Let me actually take out per share because it's harder to do. Yeah, just put it in there. I can sell off $5 of my ownership to create a synthetic dividend and still retain the value of my original ownership. Okay, so I keep the $100 I had invested in there already. They increase the value to $105. I sell off, in this case, a portion of a share. In reality, I probably purchased many shares of this company's stock, and I can sell off a share. And so I can generate a dividend from the increase in value of the stock. And that's the idea behind M&M's dividend irrelevance theory. So as a result, they say dividends are irrelevant because we can create our own. However, this theory assumes no taxes and no brokerage cost. How would this affect the validity of this theory? So over time, taxes on dividends and taxes on capital gains have differed. Currently, they're about the same. There's some odd situations where they're not, but generally they're about the same tax right now. So taxes aren't a really big deal in this case, but brokerage costs are. When I receive a dividend, I don't pay any commissions, I don't pay any fees to receive that dividend. But if I sell stock, I do pay a fee in general. There's some places where there's no fee right now, but in general, I'm going to pay a fee. And so brokerage and fees and commissions increase the cost of creating a synthetic dividend above the cost of a regular dividend. Okay. And as a result, investors are better off receiving a regular dividend that is paid out, is originated by the issuing firm. Okay. So the second theory is called the bird in the hand theory. So if you've heard the term a bird in the hand is worth two in the bush, it's based on hunting. A hunter goes out, a bird in a hand is a sure thing. They've already caught it. A bird in the bush is something that, or two birds in the bush are something that haven't been caught yet, and so they're unknown. So the idea is that a bird that you've already caught, you've already hunted, is better than two that you haven't captured yet, or two that are uncertain. And so the idea here is that M&M assumed that the dividend policy has no effect on the required rate of return on equity. Okay, so because dividends are irrelevant, they don't have any impact on the required rate of return for stockholders. Two gentlemen, Gordon and Lintner, argued that the required rate of return on equity should fall with the payment of dividends because dividends are less risky than capital gains. And we saw in that graph earlier that dividends do tend to be very stable over time, no matter really what's going on in the market. We saw, we had a big financial crisis in 2008 and 2009, and yet dividends just slipped by a little bit. They didn't slip by a whole much. So there is some basis for this idea that that dividends are less risky than capital gains. So the question here is, do you agree with Gordon and Lintner? So in class, I'd usually have people have their hands up. It's honestly a trick question because Gordon and Lintner were a little right, but they're also a little wrong. So studies show that firms that pay dividends have lower required rates of return for their equity, so for their stocks, than firms that don't. However, this is not due to the firms paying equity. Okay. So just because a firm, paying dividends. So just because a firm pays dividends, that itself does not decrease the required rate of return on their equity. What decreases the required rate of return of their equity is a decreased volatility in their earnings and in their cash flows. Firms that have lower volatility in earnings and cash flows also tend to pay out dividends. And it's because firms that generally pay out dividends tend to be a little older, a little more mature than young firms. They're out of that first initial stage, or those first initial stages for a firm, and so now they're generating consistent earnings, they're generating consistent cash flows, and then they start paying dividends. So it's that lack of volatility that reduces the required rate of return. Those firms just happen to generally pay out more dividends than those that don't, that have more volatility. And this idea is the idea behind it is endogeneity. So you probably have heard the very good idea that correlation does not result in causation. And this is the case here with dividends and the required rates of return for equity. Firms that pay dividends have lower required rates of return for equity because the firm's income and cash flows are less volatile. Okay, so the dividend payments don't actually cause that reduction in the required rate of return. It's just that they have very stable cash flows and earnings, and they're predictable, and investors like predictability. So tax effects, the tax effect theory. Prior to 2003, the Jobs and Growth Act, there was a tax preference for capital gains. Dividends were taxed as normal income at 38.6%, and capital gains were taxed at a lower rate of 20%. So investors should have preferred lower dividend paying companies. Okay. So if I received, if a company I invested in paid out cash, if they could pay it out through a stock repurchase, and so what would happen in that case is they're buying stock from investors. The investors who sold their stock to the company would have paid 20% on the gain on the sale of the stock. The companies could pay the same amount out to stockholders in the form of dividends. However, those the stock investors that receive the dividends, and that's going to be everybody, so this is something else we'll talk about later, are going to pay almost twice the tax as the investors that take the capital gain, pay taxes on the capital gains. So there isn't a really good reason for companies to pay out dividends because of the tax differential. So why did companies still pay out dividends? The idea here is that some investors prefer dividends because they represent stability and some investors rely on dividends as a form of income. And that leads us to the next topic, or the next theory, which is the clientele effect. People and institutions that rely on even payments pay few, if any, taxes, may prefer dividends. So for example, I'm on the asset management committee for the Topeka Community Foundation, and they don't pay taxes because they're a public foundation and we meet the requirements for that. We don't pay any income taxes on the returns we generate on the fund, and so as a result, the fund, we kind of like dividend paying firms because we're not paying any taxes. We also like it whenever stock prices increase because we're not paying any taxes on those gains. And so that represents an institution. The Washburn Foundation is another institution you might be familiar with that has a fairly large endowment and doesn't pay taxes. People who are retired oftentimes don't pay a lot of taxes. They don't generate enough income to pay those top tax brackets, and sometimes their retirement funds are set up in a tax beneficial way. So there's people that just don't pay taxes or pay many taxes, and they may prefer dividends as a result. So I'm going to put in here pension funds, endowments, and retirees. Pay few, if if any, taxes. And so they may have a preference. And these institutions also, especially things like pension funds and university endowments, also want regular cash flows coming in so they can pay those cash flows out. Additionally, investors that are precluded from selling stock may prefer dividends so they can receive cash flows. Which investors might be precluded from selling stocks? There's a number of different investors that might not be able to sell their stocks. Managers and board members of corporations are often required to maintain a certain level of ownership in the company, so they're required to hold on to stocks in the company. And so to generate income from those stocks, they can't sell them, so they'll like it whenever a firm pays dividends. Many years ago, I was talking to someone in the investments area at Walmart stores down in Bentonville. They actually came to me and said, we were just having a discussion one day, and they said that they were concerned about the amount of dividends that the Walton family was paying out, because the Walton family kind of controls the board of directors there at Walmart. And the Walton family doesn't want to sell their shares because they would lose control of the company. And so as a result of that, they generate income from themselves by having the company pay larger and larger dividends. And so this person was concerned that maybe they're paying out too much in dividends and not allowing for enough reinvestment back into the firm. So managers and board members of corporations, beneficiaries of trusts that hold stock in firms. So you might be the beneficiary of a trust, and there might be a restriction on that trust so that the firm cannot sell the stock. And so you're wanting the company to pay dividends so you can generate some kind of income off of that. When you buy an index fund or a mutual fund, you can't often sell out specific items of that fund, of that index. So let's say I invest all my money in the S&P 500, which is not a horrible idea. Well, but I can't sell off my shares that I own then of Amazon or of Walmart or of IBM out of that fund. There's things I can do. I can short the stock or something like that. But really, I can't just get rid of it. I have to hold on to that, the ownership in that. And so I might prefer if those companies pay dividends so I can generate income off of it. So investors that face higher taxes prefer lower dividend payouts. Now, let me explain this, because even if the the tax rate on capital gains, which is what you would generate if a firm pays out using a cash repurchase and they buy your share of stock, you can still avoid that by not selling the stock. Companies can't require you to sell your stock back to them in general. There are certain circumstances where that would take effect. But in general, they're not going to require that you sell your stock back to them. They're just going to go out in the market, and we'll talk about this a little more later. They're going to go out into the marketplace, and they're just going to buy shares of stock that people have for sale. And so you can choose when to receive that distribution if you're a stockholder. And so if I'm going to be in a high tax bracket this year, a high marginal tax bracket, I can just avoid that tax by not selling my stock. With dividends, you can't avoid it. The company's going to pay a dividend and you're a stockholder, you're going to receive that dividend. And so you're going to be required to pay taxes on that dividend, whether or not you want to receive it. So stock repurchases allow investors to defer receiving the cash distribution. Dividends don't allow that. The next theory has to do with the information content or the signaling effect of the different distributions. So when a company increases their dividend, and I need to put in here the word unexpected. Unexpected dividend increases result in an increase in the stock price. It's a happy surprise. Dividend decreases, again, unexpected. And generally, dividend decreases are unexpected. It's not something a company usually wants to do. Result in a decrease in the stock price. According to Miller and Modigliani, the result is due to the information content of dividends. An increase signals that the management and the board of directors of the company believe that earnings and cash flows are stable and are expected to decrease. Let me explain why this is, investors have confidence in this. So generally the management and board of directors for a company, the board of directors wants to remain on the board of directors because they get compensated pretty handsomely for being on the board of directors. They also gain influence. They receive shares of stock. They receive stock options. They receive other benefits for being a board member. And so they want to maintain their seats on the board. And what studies have found is that when the CEO of a company decreases, along with the management and board of directors, makes the decision to decrease dividends or eliminate dividends, in general, they won't be invited onto boards of directors in the future. And that's something that most CEOs will want to do because there are a lot of benefits to it. So that they will not set dividends too high to the extent that the firm won't be able to pay them those dividends out in the future. And so it's considered to be a pretty strong signal when a company decides that they're going to pay out dividends. A decrease signals increased volatility in future cash flows and earnings, and possibly decreased cash flows and earnings. So it's a pretty bad sign, and it's a warning sign to investors that the company's probably headed for trouble in the future. So that is the information content of dividends. Just as a side note here, so I said what research has found is that dividend increases result in an increase in the stock price. Dividend decreases result in a decrease in the stock price. Dividend initiations send a mixed message to investors. Some investors like dividend initiations. The company's going to start paying dividends now, and that's going to be more stability. Some investors don't like dividend initiations because it signals a change in the life cycle stage of the company, going from maybe a high growth period where they're young and they're growing very fast. The dividend initiation signals that high level of volatility and that high level of growth are probably ending. Back in 2003, Microsoft initiated a dividend, and when they announced that initiation, the stock price fell fairly dramatically. And that's because people who invested in Microsoft in that time wanted to be invested in a company that was growing quickly, that was reinvesting in good projects, and even growing the earning power of the company even more. Whenever they decided to go ahead and initiate a dividend, that signaled to investors that the company was slowing down. A few years ago, after Steve Jobs died, Apple went ahead and initiated a dividend. It was really past time for Apple to do this. The company was sitting on billions and billions and billions of dollars of cash, and they still are. So a lot of people feel like they haven't gone far enough with their dividend. They really revolutionized cell phones in 2006 by putting the iPhone out, and the iPhone is just a cash making machine for Apple. They sell it. The iPhone is sold at a multiple of 4 to 5 times the cost of the actual iPhone, so they generate a ton of cash off of that one product, and they're not finding really good places to reinvest that cash. So they have over $200 billion worth of cash or close to cash liquid investments right now. And so when they initiated a dividend, investors saw that favorably. Their stock price went up to reflect that feeling. So dividend initiations send a mixed message to investors. They signal a slowdown in the company, but more stability for the company. Slowdown for the company, but more stability for the company. So what are the implications for dividend stability? Stockholders rely on dividends to meet expenses. Reducing dividends to pay for capital investment can send the wrong signal about the future of the company. So again, when a company initiates a dividend and when they increase that dividend over time, and as we look at different companies, you're hopefully going to see that that's what companies do. They'll initiate a dividend, and over time they're going to relatively stably increase that dividend. If they set their dividends too high, it sends a message that management just doesn't know what they're doing. And so, if a company decides to start paying a dividend and they've got it at a certain level, and then they say, oops, there were really great projects out there that we could be investing in. And so in order to invest in those projects, we're going to cut the dividend. It really shows that management didn't know what they were doing when they initiated that dividend. So it can send this wrong signal if they're cutting dividends to pay for capital investment. Maximizing the stock price requires the firm to maintain a stable dividend policy. This means that dividends should also grow at a stable rate. So there's an equation that we can use to determine the appropriate amount of dividends to pay. So to determine the appropriate amount of dividends to pay, first we're going to start off with determining the target distribution amount over several years based on forecasted financial statements. So the target distribution amount is equal to net income for the year minus the capital budget multiplied by the target equity ratio, where the target equity ratio is equal to, the equity ratio is equal to the book value of stockholders' equity divided by total assets. So the idea here is that for this argument of the capital budget multiplied by the target equity ratio, think back to your last assignment where you looked at generating a capital budget for a firm with the estimated maximum of that budget being $20 million. So let's say we set aside $20 million for investments during a year, and we have to finance those investments somehow. And so what companies will do is they'll determine what their target capital structure looks like, and we're going to talk about that more in another topic area. But they just decide that they, for example, might want their capital structure to be financed 60% with equity and 40% with debt. Okay, so they're going to have to, if they, let's say, and I'm going to give you some dollar amounts here in a minute, but whenever they decided on that capital budget, they're going to have to determine what percentage of that amount is going to come from using typically existing equity in the form of retained earnings. So they're expecting to retain some earnings within the firm and pay some out. And then the rest of that will come from issuing new debt. Okay. So in this case, we're going to say net income, and this is just an example. The expected net income for a year is equal to $2 million. The capital budget is equal to $3 million, and the target equity ratio is equal to 0.6 or 60%. So how much should they distribute in cash overall? Well, in this case, their distribution amount, this is the amount they should plan for, is equal to $2 million minus $3 million multiplied by 0.6. And just to remember the order of operations here, we want to multiply before we do the subtraction. So that's going to be equal to 2 million minus 1.8 million. So that's going to be $200,000. Okay. And so what a company will often do is that they're going to plan this out for several years in advance. They're going to look at what they expect. They're going to forecast this out for what they expect their income to be, what they expect their capital budgets to be, and what they expect their equity ratio to be for each of the years. And so then they'll set what's called a low regular dividend plus extras policy. And so in other words, companies set their regular dividend for less than the expected cash distributions for a year and make up the difference. In other words, the difference between the total amount they want to pay out, so their distribution amount here, and the amount they're going to pay out with dividends, regular dividends, with stock repurchases, and in some cases special dividends. Special dividends are one-time dividends. They tend to be fairly large. So when Microsoft started paying a dividend, they had that dividend initiation that I mentioned earlier. The next year they actually paid out a very large special dividend. Hewlett-Packard's done it. Several companies have done it when they have a large amount of cash that they need to get rid of. They don't want to do a stock repurchase, and so what they'll do is they'll announce a special dividend that gets paid out, and it tends to be fairly large. So how do dividends get paid out? Typically, dividends are paid out quarterly. There is usually one increase per year for a dividend. The actual payment procedure looks like this. There's a declaration date. This is the date that the dividend is announced. So the ex-dividend date is the date at which the stock is traded without the dividend. In other words, if you buy the stock on the ex-dividend date or after, you're not going to receive the dividend. The holder of record date is typically the day before the ex-dividend date, except for whenever that day is going to land on a Monday, then the ex-dividend dates, the holder of record date is going to be the previous Friday or the most recent trading day. And so if you, and this is an important thing, if you purchase the stock on the holder of record date, you'll receive the dividend. If you purchase the stock on the ex-dividend date, you will not receive the dividend. So the value of the stock will usually fall by the amount of the dividend upon opening on the ex-dividend date. Okay. Then the payment date is just the date in which the dividend is paid. Okay. The value of the stock usually decreases by the value of the dividend, or very close to it, after the end of the day on the holder of record date. And that is just because that stockholder, whoever purchases it on the next day, is not going to receive that dividend, so that's a decrease in the value of the stock. So what effect does the payment of dividends have on the price of the stock? The actual payment of the dividend doesn't have any impact on the price of the stock. So on that payment date, the dividend is not new information. The payment of the dividend is not unexpected. It doesn't have any effect on the stock price. So the payment of dividend actually doesn't have any impact. The stock price may be affected by the announcement of the dividend. And I mentioned this before. If the company announces an increase in the dividend that's not expected, or a decrease in the dividend, and that announcement is not expected, then that's going to affect the price of the stock on the declaration date. And then, as I mentioned before, the value of the stock usually decreases after the end of the day on the holder of record date. So what you would expect to see is that the stock of the price between the ex-dividend date and the holder of record date, reverse that. Between the holder of record date and the ex-dividend date would fall, because the holder of record date, whoever buys it or owns it on that day, gets the dividend. Whoever purchases the stock on the ex-dividend date or after does not receive the dividend. So the value of the stock drops by the amount of that dividend on that date. And so that kind of finishes up the discussion of dividends. Now's a good time to take a little break. I'm going to keep on recording this, but now's a good time to take a little break if you would like to take a break in this video, or really whenever you want to take it. But this is where in class I would normally take a little break. All right, so the next topic we're going to talk about is distributions through stock repurchases. I want to talk a little bit about the types of distributions, the types of stock repurchases. So there are two general types of stock repurchases. The first and most common method of stock repurchases is the open market repurchase. Prior to about 1983, stock repurchases were fairly rare, and we're going to talk about that a little later on and why that changed. And generally, they tended to be what's called tender offer repurchases. So your typical stock repurchase is an open market repurchase. It's fairly transparent for an investor. You really don't, I don't know if transparent is the right word there, but you really don't see these. I mean, they exist, but they're not something that you would recognize if you're trading your stock in the stock market and you're selling your stock. You don't know who's buying it, so it could be the company, the issuing company, buying your stock. You're just not going to know it. They're no different than any other investor in that case. They're going through a broker. They're purchasing their stock through a broker, and there's some rules we're going to talk about later about that. But essentially, you shouldn't know. You shouldn't be able to tell when a company repurchases their stock because there are rules on the amount that they can repurchase in a given day. And so that is an open market repurchase. Most stock repurchases are open market. They're just going to the market just like anyone else. A tender offer repurchase tends to be a larger block of stock. So let's say that Coca-Cola wants to purchase Warren Buffett's firm, Berkshire Hathaway, their investment into Coca-Cola stock back from Warren Buffett. They're not going to repurchase it through the marketplace. It's a big block of stock. They're going to do that through a tender offer where the company will offer a certain price to a large investor like that to purchase all of their stock at once, or a large component, a large amount of that stock all at once. Because if this were taking place through the open market, first of all, it would violate some rules that we're going to talk about later, but it would also affect the stock price. And so the seller doesn't want that, because as they're selling this large block of stock through the stock market, that's going to drop the price down of that stock. And so the investor who's selling the stock doesn't want that. The issuing company doesn't want that because it would, again, drop their stock price. And so those kind of large transfers of blocks of stock are handled privately through what's called a tender offer. They're tendering their stock. They're giving up their stock for a predetermined price. Again, those tend to be more rare than an open market repurchase, and those are not done through the stock market, so they don't affect the value of the shares of stock in the market. So 3 situations lead to stock repurchases. The first is recapitalizing the company. We've seen this a lot in the last 15 years or so, where companies have a desire to change their capital structure. And so oftentimes what a company will do is they'll go out and they'll issue a lot of debt. So they'll issue bonds. They'll take the proceeds of that debt and use that to repurchase shares of stock. And a lot of companies have been criticized for this. Some companies that you might know of that have done this include Pepsi and Coca-Cola. They've both done that. I'm trying to think. I think Walmart's done it. I know Walmart has repurchased a lot of their stock over the last 15 years or so. And really, taking a look at Walmart, the Walton family went from being owners of 33% of the stock, which gave them functional control over the company. They really kind of controlled the board of directors with that 33%, but they've actually moved into a position of owning more than 50% of the stock the Walton family has, because the company has been repurchasing stock, but not repurchasing stock from the Walton family, but from other investors. And so that's made the Walton family's share of ownership in that company even larger. So recapitalizing the company is one reason, and again, that is to change the capital structure of the firm. The second reason is to have shares available for when employees exercise stock options. This is a common way to justify stock repurchases. So when we issue a stock option to an executive, the company has to have shares of stock ready for that executive when they choose to exercise their stock option. So if I have a call option, I purchased a call option and I exercise that option, the person or the institution that I purchased that option from then has to have a share of stock ready to sell me at the call price for that stock. And so companies say, well, we repurchase shares to have shares available for that purpose. There is some argument against that, especially the amount of shares that companies are repurchasing come nowhere near, the demand for shares based on this executive stock option compensation come nowhere near the massive amount of shares that companies have repurchased. The third reason, and probably the most justifiable reason for stock repurchases, is getting rid of excess cash. Excess cash can be bad for a company. So if I, go to you and say, I'm going to give you $5,000. Okay, what are you going to do with $5,000? And certainly some people are going to say, I'm going to use it to pay off debt. I'm going to invest that money into good money-making things. In reality, a lot of people are just going to go blow it. Okay? They're going to buy stupid stuff with it, or stuff they don't need, or just things that they want. And that's not always bad, but it's not good for a company to do that. And what we see in the literature, in the research, is that when companies have excess cash that they don't have anything to do with, they don't have any good projects to invest in, they're usually going to waste it. Okay, they're going to invest in bad projects, so they're just going to do dumb stuff with it. And so as a result, companies are pressed by their stockholders, by their board of directors, to either use the money for something good, or if they've got excess cash, to send it back out to the stockholders, either through a dividend or through a stock repurchase. And as I mentioned before, when a company has like a one-time or an unstable flow of cash come in, they'll usually, if they're going to get rid of it, they're usually going to use a stock repurchase in order to get rid of that excess cash. So those are the three reasons why companies distribute through stock repurchases. So the process of repurchasing stock. So for an open market repurchase, the board of directors has to authorize a repurchase program. So kind of like with dividends, the same thing occurs. Management executives are going to come up with this proposal to send out cash through a stock repurchase. Typically, the repurchase program is going to state the dollar amount of stocks that are authorized to be repurchased. In short, because the stock value is going to change over time. And these repurchase programs actually can last several years. My information on this next point is a little dated. It may have changed a little bit since I researched it a few years ago, but in general, stock repurchase programs that are completed take, on average, 3 years to complete. So these are not fast programs. Once a board authorizes a stock repurchase, there's no requirement that the company go through with it. Okay. And again, this next item is a little dated, but it gives you an idea that only about half of stock repurchase programs, announced stock repurchase programs, are completed. When a firm announces a cash dividend, there is a requirement in a way that those dividends are actually paid out. That's not true for a stock repurchase program. The company can they can announce that they're repurchasing stock and then never go through with it. And there's a variety of reasons why a company might not go through with a repurchase program. It can be that stock prices increase, and so they don't feel like it's a good buy anymore, that the stock isn't a good investment. The cash that was available to purchase the stocks might be used for something else, or might go away because the company runs into some problems. There's a variety of reasons, though, why a company won't complete a stock repurchase program. The main thing about this is that I want you to know that it's flexible, okay? That the programs are flexible and don't require that the stocks all be repurchased. So they go through, they announce the repurchase, and then they go through and actually, for an open market repurchase, the issuing firm, so if it's Walmart and they're repurchasing Walmart stock, they're going to hire a stockbroker or maybe multiple brokers or multiple people within the same firm to repurchase the stock along regulatory requirements. And we're going to talk more about that here in a minute. But there are requirements. The company can't purchase too much stock in one day. And they're also going to look for times when the value of the stock dips so they can buy it at a cheaper amount. So a brief history of stock repurchases. Open market repurchases didn't really exist in the United States until 1983. And I'll explain why that is here in a minute. You should also know that there are only really 4 countries in the world that allow regular open market repurchases. This is because there's a fear that firms might use these to manipulate a firm's stock price. So in other words, I can boost the price of my stock by going and out there and putting a lot of purchasing pressure on the stock. So in this case, the demand for the stock, because the company is out there actively trying to buy shares, the demand for stock can outpace the supply and increase the price of the stock. And the SEC, the Securities and Exchange Commission, actively works against companies trying to manipulate their stock prices. So there was a lot of fear that companies could do that. In most countries in the world, a stock repurchase requires a vote from the stockholders. In the U.S., it does not. And in also in the other three countries that I mentioned before, it does not. So it just requires a vote by the board of directors of the firm. So in 1982, I got down below 10 rule. Rule 10b-18 was passed. This was a rule passed by the SEC, and I'm going to come back and explain what that is here in a minute. Which is referred to as a safe harbor rule. And this is a rule that was put in place by the SEC. And the SEC, the Securities and Exchange Commission, and the reason why open market repurchases became more common in the U.S. after this is it gave firms guidelines to follow so that they wouldn't be, or the Securities and Exchange Commission wouldn't consider their purchases to be trying to manipulate the stock price. Even with that in place, though, open market repurchases really didn't take off until the early to mid 1990s. There's a lot of things that happened, and some of this is just conjecture on my part. But in 1994, Congress passed a law that restricted the tax deductibility of executive salaries. And so as a result, so I'll just briefly explain what happened. Congress felt like politicians felt like executives were making too much money, that executive compensation was exploding. And so as a result, what they did is they said, okay, we're going to limit the amount of salary that you can deduct on for tax purposes on the firm's income statement. So, you could pay your CEO a $5 million salary every year, but only the first $1 million is deductible for tax purposes. And the result of that law was that a lot of companies then restricted the salary portion of an executive's compensation to $1 million. But they made up for that because through incentive compensation. So incentive compensation, all of it was tax deductible. So if you paid your executive a bonus based on accounting measures, that was fully deductible as long as it met the guidelines of incentive compensation. If you gave your executives stock options, those were tax deductible. If you gave them restricted stock, that was tax deductible as well, as long as it met the definition. And there's some legal issues, and Apple actually ran into this a little bit. But the result of this rule about compensation resulted in firms tying the income of the executives more and more to the stock price of the firm. So what we know by studying stock repurchases is that when a firm announces a stock repurchase, an open market repurchase, that the stock price usually increases by 1 or 2%. And that is a result of the announcement effect. The firm is, just like with dividends, the firm is announcing that they have excess cash, and the firm feels that it is stable enough to pay out that excess cash, so they're not going to need it for an emergency in the near future. And so that kind of speaks to the stability of the company, and so the stock market generally reacts positively, not by a large amount, but by a small amount whenever a firm announces a stock repurchase. As a result, the increase in reliance on incentive compensation or stock price based compensation resulted in an increase in the prevalence of stock repurchases. Okay. And that's what we see. If you go back to that graph I showed you earlier, we saw that it just starts with 1999, but before that, stock repurchases kept increasing and increasing throughout the 1990s, and then you saw what it did after 2003 or 2004, that it really just took off. And that's kind of been the history of a brief history of stock repurchases. Now, I mentioned 10B, Rule 10b-18. Again, it was passed by the SEC in 1982 and provided a safe harbor that allowed firms to repurchase their shares on the stock market. Specific provisions and there are a lot of provisions in Rule 10b-18, and in fact the rule was updated in 2003, but some specific provisions include that, and there are some of these rules are based on the size of the company, but in general the firm can only use one broker per day. In other words, they can't hire different brokers to buy their stock during a day, because they want the SEC wants the trades to be clear, and the firm has to report these trades later on, a month or two after they've been made. They'll announce what they did. They can only use one broker per day. They can't purchase more than 25% of the daily average volume of stock trades. Of stock traded during a day. So, for example, if a firm, on average, if let's say 1,000 shares of a firm's stock is traded during a day, on average for like the last month or so, a firm can't purchase more than 250 shares in a day. That would be too much. The firm can't be the first or last trades. The firm purchasing stock can't be the first or last trades of a day. price paid can't exceed the highest price during the day. In other words, it really it can't be the highest price during the day. And so these are some general rules that are included in Rule 10b-18. So for example, the size of the company will dictate how soon to the end of the day they can trade. Small companies can't trade within the last, they can't purchase stock within the last 30 minutes of the day because of the stock may not be very liquid. So if they trade in the last 30 minutes, there is a very real possibility they could be the last trade of the day. For very large companies like your Walmart, your Amazon, your Google, those can trade up to the last 10 minutes. And so, in other words, those companies can't trade within the last 10 minutes of the day. And all of these rules are in place in order to inhibit the company from manipulating their stock price. There are more rules that go along with this, but these are the big rules. And again, the goal of the rule is that the firm shouldn't be able to manipulate the stock price through trading. So what are the effects of stock repurchases on the firm value? The act of repurchasing itself should have no effect on the stock price. And especially because if the firm is fairly priced in the marketplace, then you're just exchanging value for value. And this, I started studying this topic about 18 years ago, and I had a really hard time with this idea. So let's say your company's stock, the current stock price is $50 a share, and that is fairly priced. It's not overvalued. It's not undervalued. When you take $50 out of your bank account for the company and you go to the market and you purchase that $50 share of stock, there's no change in value for the company. It took $50 out of their account in cash and traded it for a share of stock worth $50. And so as a result of that, the act of actually repurchasing the stock should have no effect on the value of the company. Again, it took me a long time to really get that idea, because I always felt like, well, they're giving up $50 in cash. The company there should be an effect on the stock price, but in fact there shouldn't be, as long as the share is fairly priced. The announcement of the repurchase should increase the stock price, and this goes back to the information content of the announcement. If you go back and look, we talked about this for dividends. The announcement should communicate that the firm feels that, and when I say by firm, let me change that. The management of the firm feels that the firm is safe enough to get rid of some of its excess cash, so it can reduce the size of its rainy day fund. Additionally, the company, or the management of the company, wants to communicate the idea that the firm stock is undervalued in the market. And you might ask, well, why is that? Why would they want people to think that it's undervalued? Well, if they can convince investors that the firm is undervalued, investors are going to go out in the market then and bid up the stock price to the point where it's no longer undervalued. Because it's like telling someone that that an item that they're looking at buying is worth more than the price that they're paying for it. And so it's a deal. And you know, companies try to do that as well with their stock prices. Letting people know this is a really good deal. You should go out and buy our stock too. We think it's a really great deal, a really great price for our stock. And so essentially what they're doing is they're taking the stockholders' money, that cash that they have, that's really, it is really owned by the stockholders of the firm. And they're taking that cash and they're saying, this is a good investment for our stockholders. We're going to go out and we're going to repurchase that stock of ours because it's undervalued, and we're going to bring it in-house. I'm going to talk more about that in a moment. Okay, but they want to communicate that the firm's stock is undervalued, and as a result of that information content and just the idea that the company is stable enough to do this, that's going to increase the stock price. And I mentioned before that usually we see a 1 to 2% bump in the stock value on the date of the announcement. Finally, the act of repurchasing will decrease the number of shares outstanding. So there are two approaches on how a company accounts for share repurchases. The first method, is often referred to as the Treasury stock method. And the Treasury stock account on a financial statement for a firm is a contra equity account. So you might look at the financial statements for a firm and see treasury stock. It will often be a negative number. And so this is a reduction in the value of the equity of the firm, because what the company did is they took retained earnings and they went out into the stock market and they purchased stock. Okay, and so the amount in the treasury stock account is the total dollar amount of stock repurchases that they've made. Is the total amount of stock that the firm has repurchased. So let me show you an example of this. I'm going to go out. Pepsi's done a lot of this, so we're going to look at Pepsi really quick. Oops, not Pepsi, Pepsi. Here we go. So I'm going to go out here. Oops, that's not it. There we go. All right, here we go. I'm going to look out here on their balance sheet. If you look down here, it says Treasury stock. This is the end of the year, December 28, 2019. So the total amount of stock that the Pepsi company has repurchased is $36,769 million. So a lot. They've repurchased a lot of their stock, and they've been doing this for several years now. You see, back in 2014, the total amount that they had repurchased was $24.985 billion worth, and so this has increased by almost $12 billion worth of stock over the last 6 years. So they repurchased a lot of stock, and that's how it shows up on the financial statements using this method. Okay, the second method involves the firm retiring the shares of stock. And essentially what they do in this case is that they just eliminate the shares. There's not a contra equity account. The shares are just eliminated, and the value of common stock on the equity portion of the balance sheet just goes away as a result of this. So with the first case, there's going to the stock that they repurchased still exists. They can reissue that stock if if that's allowed for by the board of directors. Oftentimes they will reissue some of that stock to executives as they exercise their stock options. With the second method, the shares of stock are repurchased and then destroyed. Okay, they just don't exist anymore, and so the value of the firm's equity will be reduced by the value of the shares that have been eliminated. Primarily, companies will use this first method. You'll see Treasury stock on a lot of balance sheets because that does give them the flexibility of reissuing those shares in the future. So let's compare repurchases and dividends. Ignoring tax effects and signals, the total market value of equity should be the same whether a firm pays dividends or repurchases stock. Because you're not changing the business of the firm, you're not changing their business activities, you're not changing their earning power by how you choose to distribute cash. And again, this ignores the signals, and we'll talk more about this here in a minute, but the signals are different between a stock repurchase and a dividend. And the tax effects can also be different between the two for an investor. The repurchase does not change the stock price. I mentioned that before. The actual act of repurchasing, especially if the company's shares are fairly valued, you're just exchanging value in cash for value in stocks, and so that should not change the stock price, although it does decrease the number of shares outstanding. Finally, the stock price for a company that repurchases its stock will climb faster than if it pays a dividend, but the total return for shareholders will be the same. So the reason for this is that a firm's return is made up by the dividend yield and the capital gains yield. The dividend yield is equal to the next expected annual dividend. So, if a firm pays 4 dividends per year, it's going to be the sum of the next 4 dividends divided by the current stock price. The capital gains yield is equal to the change in the firm's stock price divided by the initial price. So let's say if I purchase a share of stock for $100, and during the year the stock price increased to $106 and the firm paid a dividend on the share of $4, my total return for the year is 10%, consisting of a dividend yield of 4%, which is $4 divided by the initial $100 that I purchased the share for. So that'd be 0.04 or 4%, and a capital gains yield of 6%. So this is going to be 106, the ending price, minus 100 divided by my initial price of 100, which gives me $6 over $100, which is equal to my 6%. So my total return for the stock is equal to my dividend yield plus my capital gains yield. If a firm pays more and more dividends, that dividend yield is going to increase, but that's also going to reduce the amount that the firm is going to reinvest into the company, and that's going to reduce the growth in my stock price. So that's an increase in a dividend payout. In the dividend payout ratio decreases the amount that is invested back into the firm and decreases the growth in the stock price of the firm. And so that's the idea here behind this last comment. The stock price for a company that repurchases its stock will climb faster because they're not paying out dividends. In other words, they're kind of investing in the stock of the company. And so they're increasing the stock price. And we mentioned before that there's an announcement effect. And so they're increasing the stock price of the firm, but they're not paying out dividends. Okay. And so there shouldn't be a difference in the returns for a stock if everything else is the same except for how they pay out their cash. So some comparisons of dividends and repurchases. So advantages of repurchases. The big advantage is the flexibility of the repurchase. So that's a big advantage of the repurchase. The dividend does not allow for that. Once a company starts paying a regular dividend, the expectation is that dividend will continue and it will get larger over time. So that dividend kind of traps the company into paying more dividends. Okay. So repurchases offer a flexible method to pay out excess cash, and they offer an easy way for a firm to change its capital structure. They can do that very easily by just issuing a lot of debt and using the proceeds of that debt to repurchase the stock. Repurchase announcements often increase the stock price. So we see a positive excess return on the announcement dates. Some of my research that I did many years ago actually showed that the market could tell if the company was actually going to repurchase the stock. So after a few months after 9/11/2001, companies issued stock repurchase announcements like crazy. The SEC, for a brief time, said that companies didn't have to follow parts of that safe harbor rule, And so they just went crazy announcing stock repurchases. The investors in the market correctly determined that companies weren't sincere in these announcements, that really the goal of the companies and actually the goal of the SEC was to increase stock prices, because stock prices, as you can imagine, got hammered after 9/11. So what actually happened was that the New York Stock Exchange was shut down on 9/11, because it actually, if you've been to New York City and you've seen it, the Twin Towers were very near, just blocks away from Wall Street, and so they shut everything down that day, and it remained closed for about a week. After that, everything was shut down, and so the stock market wasn't trading there in New York. And whenever it opened back up, stock prices plummeted by about 25%. In order to, and really the idea was that the drop in the stock prices weren't because companies were no longer able to earn profits, but because people were very scared. And so as a result of this, the SEC did allow companies to not follow that safe harbor rule for a little bit in an effort to get stock prices pushed back up. So I did a study on this and found that, the investors can usually tell if a company is going to repurchase stock, and the stock prices generally don't increase on the announcement date if the company doesn't follow up with actually repurchasing the stock. So those are the advantages of stock repurchases. And again, the big advantages is that they're very, very flexible for a firm to use as a method of cash payout. So the disadvantages of stock purchase, primary disadvantage, let me put another advantage up here, sorry. Repurchases allow investors to choose when they are going to accept a distribution. You don't get to choose, if you own stock in a company and they pay dividends, you don't get to choose whether or not you accept that dividend. With a repurchase, I can choose if I'm going to accept that distribution, that cash distributions, by just choosing not to sell my stock. The primary disadvantage of a stock repurchase is that while their announcement does often result in an increase in the stock price, the signal of a stock repurchase announcement is much weaker than the signal given by an increase in a dividend. So the analogy I like to use is asking someone out on a date versus proposing marriage to someone. Okay. A stock repurchase is like announcing a stock repurchase is like asking out someone on a date. You ask them out on a date. If it doesn't go well, you don't have to redo it. No, there's no expectation that hopefully, there's no expectation that asking someone out on a date is going to result in you having multiple dates. Okay, one and done. See if you're interested. If not, you won't repeat it again. And that's how a stock market repurchase works. They can do it once and there's no expectation of it going forward. So it sends kind of a weak signal. A dividend, announcing a dividend, announcing an increase in a dividend is committing the company to a long-term relationship, which is expensive to get out of. It will drop the stock price. And so it sends a much stronger signal to investors and to the market when a company announces a dividend or announces an increase in a dividend about the future of that company and the nature of the relationship between the issuing firm and the investor. So that is the primary disadvantage. So some conclusions. Because of the deferred tax on capital gains, repurchases have a tax advantage over dividends. Dividends are better suited for those that need a steady source of income, and so that's referring to investors. Repurchases are useful when a firm wants to make a large shift in its capital structure, wants to distribute cash from a one-time event, or wants to obtain shares for use in an employee stock option plan. Some constraints for cash distributions are bond indentures. So there will be negative covenants, often restrict the cash payments to equity investors. In fact, if you're following the news right now, I'm recording this on March 25th. The Congress and the White House is kind of announcing, it's kind of off and on, announcing a deal, a stimulus package. And part of that will be no interest loans to major corporations. One of the covenants, one of the requirements of that loan is announced to be, at least, a restriction on stock repurchases. So this is a very good example of what I'm talking about here. And I've heard that it's either for a year or for until the loan is repaid. But those are not uncommon things to see. Preferred stock restrictions. So preferred stock receive their dividends before common stockholders are allowed to receive dividends. The next rule, the next constraint, is an impairment of capital rule. And in general, what this rule does, these tend to be state level rules that don't allow companies to pay out so much cash to their equity investors that it would impair the ability to continue to function. Another constraint is the availability of cash. If a company doesn't have cash to pay out, now then they just can't pay out cash. So a firm can generate income but not have cash because the cash is being used elsewhere, or they generated positive net income but didn't receive cash from their customers. And so if a firm doesn't have cash to pay out, they just can't pay cash. The last one is one that I used to get really excited about, and then I did some more research on it. I'm less excited about it now, but there's a penalty tax on improperly accumulated earnings. However, it generally does not apply to publicly traded firms. So if you have a privately traded firm and you're not paying out cash to the equity investors in an attempt to avoid taxes, so in other words, a company just generates income, it generates cash and just holds on to all of it, because if they paid it out, then their investors, if they pay out dividends to their investors have to pay tax on that. And I always thought, why do companies like Apple, who generate and hold on to so much cash, get away from not paying this tax? It's because it doesn't apply to them. So this only applies to privately held firms. I should put it here, in general, only applies to privately held firms. And the idea is that a firm cannot just hold on to earnings and cash in an effort to make sure their investors don't pay taxes, okay, or to avoid taxes for their investors. Publicly traded firms are given a lot of leeway on that. The SEC and Congress and the IRS kind of believe that investors will put pressure on a publicly traded firm to pay out excess cash. There are also alternative sources of capital, and this can create a constraint for firms. So the cost of selling new stock, the cost of issuing new stock is high. And existing firms, if they're publicly traded, generally avoid issuing new stock. This can decrease the desire of management to pay out cash if the firm cannot do so without having to issue new equity in the future. In other words, they just want to avoid paying out, issuing new equity. So they don't want to pay out so much cash that they might need to do that in the future. Also, a firm's ability to substitute debt for equity. If they don't have the ability to substitute debt for equity, they're going to be less likely to pay out cash. And what I mean by this is really just the ability to issue debt. So if a firm doesn't have a strong ability to issue debt, so for example, right now, JCPenney has horrible credit ratings. It would be difficult for them to go out and issue new debt, at least on reasonable terms. And so they have a low ability to issue debt. They're not probably paying out cash to their investors. They're less likely to pay out cash. And I talked before about companies like Pepsi who do this on purpose. They purposely go out and issue debt and then use the proceeds to repurchase stock to recapitalize the firm. Finally, control of the firm. The use of debt to repurchase stock can actually increase some shareholders' control of the firm. I mentioned this with the Walton family. They are able to increase their control of the firm through the firm's use of stock repurchases. Additionally, and kind of alternatively, dividend payments. If a firm has a controlling family or, blocks of stockholders that own large blocks of stock, those stockholders may want to generate income from the firm without losing control of the firm. And so in order to do that, the firm's going to have to pay out dividends. So, if I own 50% of the stock of a firm and I have control of that firm, I may want income from that firm, but I want to do that without selling stock. So I will push the company and push the board of directors to issue dividends for that firm. So dividends allow the stockholders to receive cash distributions without decreasing their control of the firm. Okay. So firms that have a lot of family stockholders and block stockholders will often pay out more dividends. So the overview of the distribution policy. Distribution policy is made jointly with capital structure and capital budgeting decisions. We go back up here to the target distribution amount. It is a combination of all three of those. So it's a combination. We have capital budgeting here. So the firm has a capital budget of $3 million. Capital structure. We have to determine how much of that capital budget is going to be paid for using equity or, in general, retained earnings versus debt, issuing new debt. And so your distribution policy is going to be made jointly with capital structure and capital budgeting decisions. And we're going to, that capital structure is the third piece we're going to talk about in another topic area. So now we've kind of covered two of these topic areas: capital budgeting, cash distribution, and then the third piece to this is that capital structure issue. So the last topics we're going to talk about in this section are stock splits and reverse splits. You may be familiar with these. We can have an example here of a stock split. A common one is a 2-for-1 split. So if a company engages in a 2-for-1 split and the original price is $20, the new price of that stock is going to be $10 per share. The new number of shares outstanding is going to be 200. The key thing I want you to know about this is that the value of the company's equity does not change. The market value of the company's equity doesn't change. The market value of the firm's equity to begin with was $2,000, $20 multiplied by 100 shares outstanding. The new value is $10 versus multiplied by $200 or 200 shares outstanding. Again, $2,000 either way. So why do firms split their stocks? Firms split their stocks in order to keep the stock price, in order to keep the stock liquid. In other words, to keep the price low enough so that investors can afford to purchase shares. So let me give you an example of what happens when a company doesn't split their shares. So this is Berkshire Hathaway's A stock, and it has gone down tremendously in the last few weeks. It was priced at $330,000 a share. It's become a little bit more liquid over the last few weeks, going down to $270,759 per share today. It increased by $3,669 a share. Okay. So I will give you the offer I give to all of my classes when I discuss this stock. I am willing to negotiate your grade in exchange for a share of Berkshire Hathaway A stock. So if you've got a share lying around, you want to talk about grades, I'm happy to talk to you about your grade and seeing what we can do to help you out with that. What I want you to see here is that really high price. The volume for this stock today, it traded 951 shares. The average daily volume, in other words, the average number of shares traded, is 450 shares per day. It is a very illiquid stock. It doesn't trade very much. Berkshire Hathaway has a B stock. Let's look that one up. So that's BerkB. BerkB has a long story behind it. It's trading at $180.47. It has a long history behind it. Many years ago, an investor decided they were going to take advantage of the fact that Berkshire Hathaway would not split its stock. And Warren Buffett really was the one who came out and said, I want people investing in my stock for the long run. I don't want them buying my stock and selling it the next day. I want to encourage that. As a result, I will not split my stock as the stock price goes up. I want people to really buy into my stock, and so I won't split the stock. So an industrious investor said, well, I'll do it. So they purchased shares of Berkshire Hathaway A. They kind of split up the control of those shares by selling rights to that share of stock, and charged a 3% fee, an additional fee, to invest in that right to a portion of a Berkshire Hathaway share of stock. Warren Buffett said, if someone's going to make money on my stock, it's going to be my company, Berkshire Hathaway. So they came out with the Berkshire Hathaway B shares, which is just really a portion of a small portion of an A share. It actually went up in value to several $1,000s per share. And then a few years ago, when Berkshire Hathaway purchased BNSF Railways, part of that deal was that they gave BNSF shareholders, they exchanged shares with them for shares of Berkshire Hathaway stock. Berkshire Hathaway B stock split up enough to take the price down to $75 a share. And so the BNSF shareholders, in exchange for their shares of stock, received a share of the a B share, which was at that time valued at $75. It's done very well over the years too. You can see it's up to $180.47. It has, I'll just take a look here. You can see it has taken quite a drop, as have most stocks in the marketplace over the last few weeks. The volume here, remember the last one, the average daily volume was 450. The average daily volume of this stock is $6,678,116, which is a far, far higher volume. This is not an illiquid stock. It is a very liquid stock, and investors can buy and sell out of it very quickly. So that is why companies split their stocks, to keep the stock liquid. Okay? So investors can buy it and sell that stock. It is usually a good sign. The market reacts positively to stock splits, because there is a cost to the company to split the stock. You have to hire accountants. You have to, work with the investment banks in order to make that split happen. So they're just not going to do it because they feel like it. The announcement of a stock split indicates that the management of the firm believes that the stock price will continue to increase. Okay, and so sometimes we'll see a little bump in the value of the stock when they announce that stock split. The reverse split is not a good sign for a company. So I put in here an example of a 1-for-2 split. The original price is $20. In a 1-to-2 split, the new price would actually be $40, and the new number of shares outstanding would be 50. Again, the idea here is that the company is not changing the value of the company by doing a split or a reverse split. The goal of companies when they reverse split their stocks is to increase the price of the stock, usually to keep the stock from being delisted from an exchange. So the New York Stock Exchange and then the NASDAQ exchange have requirements in terms of the price of the stock. It can't go below a certain price, and it's different for the different exchanges. but in general they have to maintain a minimum price, and if it goes below that minimum price, and it might be $2, it might be $4 for more than 30 days, then the company gets delisted off the stock exchange. The stock becomes even more illiquid if it's not very liquid to begin with, and the stock actually loses some value as a result of that. And so companies will often engage in reverse splits in order to bump the stock price up. And I give the 1-2 split as an example. I've seen 1-10 splits. I've seen much higher reverse splits than that, really to push the stock price up. A company named Kohler. They make bathroom fixtures generally and toilets and things like that. They actually did an incredibly large reverse split to eliminate stockholders, and so it was something like a 1-75 split. And the idea is they wanted to push out anyone who didn't own enough shares out of ownership of the company, and the goal there was to make it so the company didn't have to go public. Once a company has so many shareholders, they're forced by the SEC to become a public company. So they wanted to avoid that, so they did an extremely large reverse split to eliminate certain stockholders and paid them cash for their shares. The result of that was a very large lawsuit whenever the courts found that they did not give those investors whose shares they took enough money for their shares. But that's a long story. Just know that it is something that happens, and it's generally not a good sign for the company when they engage in a reverse split. A stock dividend is a little strange. In this case, what the company is doing, rather than engaging in a split, they're giving stockholders, instead of cash, they're giving stockholders additional shares of stock in the company. My old finance professor from when I was an undergraduate hated stock dividends. I still remember it. It's been a few decades ago, but he just hated stock dividends because he said companies really only do this in order to make investors feel like they're getting something when they aren't. I don't take the same view. I've heard that view from other people too. I don't take the same view because these stock dividends can be used in the same manner as a stock split. So, for example, with a 10% stock dividend, the original price is $20. The new price is $18.18 per share, approximately. The number of new shares outstanding is going to be 110. If I multiply, let's see here. There we go. If I multiply my $18.18 per share by 110, I get, it's a little bit rounding error, I get $2,000 though. So the value of the company doesn't change. This approach allows the firm to keep their liquidity liquid, or excuse me, their stock price liquid without having to significantly change the number of shares outstanding or the stock price. It's not such a dramatic change as a stock split is, and so it lets the company little by little keep the firm's stock price liquid. So down below here I've got stock splits and dividends and their effect on stock prices, and I mentioned actually some of this before, but let me just go through it to keep things consistent. Firms' stock prices tend to increase with the news of a stock split and tend to decrease with the news of a reverse split. Stock dividends can have a positive effect on firms' stock prices. The effect on prices is due to the information content of the announcement. So again, when a firm announces a stock split, they're announcing that they expect the stock price to continue to increase. Otherwise, they wouldn't split the stock in an effort to keep the stock price liquid. When a firm announces a stock dividend, again, the same thing applies. They're announcing that they believe the stock price is going to continue to increase. Okay. When a company announces a reverse split, they're giving the opposite information out there. It's kind of a desperate Hail Mary to increase the stock price to keep the company from being delisted, with the idea that the stock price is not going to increase on its own. Okay, it's not going to increase on its own. Stock splits and stock dividends give investors the information that managers expect stock prices to continue to increase. Reverse splits give investors the information that the stock price is not expected to increase and may decrease. And again, companies really want to avoid those reverse splits. They are a bad signal about the company. The company is about to be delisted off the exchange, and there's not an expectation that the stock price is going to increase to avoid that. The last topic I'm going to talk about are dividend reinvestment plans. Dividends are automatically reinvested in the firm's stock. So you can choose when you purchase stock, oftentimes, you can choose what the broker will do with those dividends, or the issuing company, what they'll do with the dividends that they would send to you. Either you can say, go ahead and send me those dividends, or you can tell them to reinvest those dividends back into the firm's stock, so that whenever shares are, when you receive dividends, that cash flow can automatically be used to purchase new shares or portions of new shares of the firm's stock. There's two types of these. One type is through the broker. Usually there is a discount on commissions, if there's even any commissions at all, on the purchase of shares using a DRIP. And again, remember, it's an automatic reinvestment. The other type is through the issuing company. In this case, this is really the really good case, and if you can find this, it's usually a great deal. The firm sells shares through a DRIP. So in other words, this is going to be the issuing company. So if I buy shares of Walmart stock and they offer a DRIP to their shareholders, they're going to take those dividends. If I enroll in that DRIP, they're going to take the dividends I would receive, and they're going to buy shares of their stock for me, and those shares go into my account. However, if it's through the issuing company will often sell those shares at a discount to the DRIP participant. So let's say a common one might be a 5% discount. So that gives me an automatic 5% return whenever I allow a company to reinvest my shares into new shares of stock at a discounted price from what it's selling in the market. So that's usually a pretty good deal for an investor. Over time, the number of DRIPs offered by issuing companies has declined. And then that's just because they got so popular that the firms didn't want to issue that much new stock. And so they just kind of cut those off a little bit. The key thing to know about DRIPs is that individuals still pay taxes on the dividends. So if a company pays dividends and I choose to enroll in a DRIP, I still have to pay taxes on those dividends, although I'm not receiving the cash flow. A large percentage of investors choose to enroll in DRIPs, which may suggest that firms pay too many dividends. So that's it for this topic. It's one I really enjoy. I hope you find it interesting. I'm more than happy to talk to you more about it if you have questions about it, or would like me to go over something in the notes that I've gone through in a little more detail or a little more thoroughly. Please let me know. I'm going to also put out online, along with this set of notes, and assignment. I'm going to ask you to read a journal article about stock repurchases. They've been in the news a lot, and then to answer some questions about that article. I hope you have a good week. Let me know if you need anything.